Not just equities, foreign investors bullish on Indian debt papers too. August marks the first month of positive net inflows at over $1.6 billion, highest since March 2019. In another news from Mumbai, foreign portfolio investors turned the net buyers of local debt securities for the first time this calendar year. They purchased a net of $1.635 billion worth of bonds in August, bucking the trend of monthly net sales earlier this year, show data from National Securities Depository. Global investors flocked back to buying spree after the RBI had hinted at retaining the accommodative rate stance to spur the country's growth. This is the largest single-month net purchase of debt papers since March 2019, when they had bought $1.7 billion. Clearly, the pace has picked up once the wheels of the economy got moving, said Sriram Krishnan, Managing Director, Deutsche Bank, India. The increased FPI flows to Indian fixed income can be attributed to the accumulation of deals and discussions during the pandemic period. The exchange rate, too, has played a role in wooing yield-hungry international debt investors who sought growth opportunities amid negative interest rates. Record high rupee liquidity, drop in inflation, and decline in the rupee hedging cost has made Indian debt attractive, said Anindya Banerjee, a currency fixed income analyst, Kotak Securities. A relatively stable rupee on the back of dovish US Fed and positive growth momentum in India is one of the factors that they may have encouraged FPIs to bet on India's debt, he said. The durable surplus liquidity in the banking system is now at 1.33 lakh crore. The one-month Bloomberg US dollar to Indian rupee conversion volatility index dropped by 10 points to 4.65% in August with little spikes. This year, overseas investors net sold $1.5 billion worth of debt securities compared with about $7 billion net invested in local equities. Global central banks have resorted to bond purchase programs to infuse liquidity into the system, a move aimed at arresting the rise of the economic cost of the pandemic. This has pushed interest rates into negative territory, meaning you have to pay for owing sovereign debt securities. The value of the world's stock of negative yielding debt has ballooned to more than $16.5 trillion, show an estimate by the Financial Times. Countries like Japan and Germany are seen ushering in the trend. Government bond yields have tumbled in the past few months, especially after US monetary authorities hinted at an immediate tightening of rates. The US Treasury benchmark dropped about 40 basis points to 1.31% in the past 6 months. This has collectively burnished the allure of emerging market debt securities, particularly when the cost of covering currency risk has dropped. The hedging cost has dropped at least 100 basis points across different forward contracts running in 2 months. Earlier on August 6, the Monetary Policy Committee voted a favor of extending the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy. The central bank aimed to ensure the inflation remains within the target band, plus or minus 4%.